To all you value macro investors, December 1st, 2025, it's the date that QT officially ends, quantitative tightening. Now, what in the world does that actually mean? Well, first off, here's what nobody's telling you. This is really only the second time in financial history that this has ever happened. The first time quantitative tightening ended was mid-September 2019. Shortly after, crypto was about to rip. Then COVID crashed everything early 2020. So right now, the question everyone's asking is what happens to the crypto market specifically when the Fed stops draining trillions of dollars from the system? Because this is what has been going on for years now. And more importantly, the purpose of the video, can we actually use 2019 as a roadmap, or did COVID completely invalidate that playbook? Somebody asked me this exact question in yesterday's video. They said what would be really helpful is if you looked at prior cycles to see how long it took for markets to pump after QT ended. And after diving deep into the data, what I found might change the way that you're positioning for Q4 2025 going into Q1 2026. So hit the subscribe and like on your way in. And if you're not in our intelligence system with our risk models, our exit planners, and a ton of different data, hit the link below, get set up with the trial. So I guess first, let's get one thing straight. Quantitative tightening, quantitative easing are not these ancient monetary tools that have been cycling now for decades. This is very new stuff. I'll go a step further and say this is very experimental stuff. And right now, when it comes to QT ending, we're only in round 2. And round 2 hasn't even begun yet. That's what December 1st is for. You see, quantitative easing was invented during the 2008 financial mess that happened. The Fed's balance sheet was under $1 trillion, and then they held it there. Then started the first ever attempt at quantitative tightening in October 2017. So 2017 wasn't even that long ago. So you heard it right. This was the first time in human history a central bank tried to unwind a balance sheet that was this large. And what happened? They drained about $700 billion over 2 years. And because of it, markets started cracking. December 2018, the S&P 500 dropped 20%. And then repo markets seized up in September 2019. And that's right when the Fed made their move. Mid-September 2019, quantitative tightening officially ended. And the Fed pivoted, going back to eventually expand the balance sheet. Wasn't full QE yet, but the drain stopped. Now here's where it gets crazy interesting for crypto. And this is so important for all of us value investors that are here investing on the macro. Look at the total crypto market cap chart from mid 2019. Do you see that range? Bitcoin hovering around $10,000. Altcoins were consolidating. Then quantitative tightening ended September 2019. It is so important to note for where we are right now with quantitative tightening about to end. For about 90 days in 2019, when quantitative tightening ended, nothing dramatic happened. There was actually a slight dip initially. Then around mid-December 2019, you start seeing green candles building. By January 2020, crypto was starting to move post-QT. It looked like we were heading into a major breakout. And if you were here back then as a crypto investor, you might remember this time period. Then all of a sudden, March 2020, COVID. Total capitulation. Everything crashed 50, 70% within days. So right here is the problem with using 2019 as our historical comparison. We don't get a completely clean sample. We had 5 to 6 months between quantitative tightening ending and the world basically shutting down. So essentially, we didn't have enough time to see the full effect of that policy shift play out organically. And there's not been any other time where we've seen quantitative tightening end that we could even use as an example. But here's what we do know. Those first 90 days showed accumulation and stabilization. And one thing we've been talking about is liquidity doesn't hit markets instantly. We're seeing that even with the shutdown now coming to an end. We're not seeing an instant liquidity flow back into the economy. It takes time to flow through the system. And as we've talked about, business cycles, they turn even slower. But the Fed stopped draining in September 2019. And it took multiple quarters for that to show up in corporate earnings, hiring, and really just all around risk appetite. So now that we have some context into the first and only time so far where we've seen quantitative tightening come to an end, let's talk about December 1st, 2025, and why this might not take 90 days. This is a short-term liquidity event. When the government reopens, contractors get paid, federal employees get their paychecks, projects restart, and that is immediate liquidity injection. And in the context of everything we're talking about here, it's much faster than the slow turn of ending quantitative tightening. Secondly, and this is a big deal, the SEC has reopened, and at the same time, they are opening the floodgates for altcoin ETFs. This was not even close to a conversation in 2019. Right now, as I record this video, We are talking about institutional grade wrappers for crypto assets. Bloomberg terminals are now lighting up with crypto ticker symbols. Compliance departments getting comfortable. Can you even believe that? This is structural adoption happening in real time as we have a massive liquidity event on the short term and macro horizon. Third, and I can't stress this enough, on-chain data is simply screaming a redistribution. You and I, as a part of retail, we have felt the frustration of these markets, of the extended business cycle, and it just is a reality. But retail has been selling to institutions all year, and long-term holder supply is consolidating. Putting it very simply, a lot of people are getting shaken out of the market. This isn't 2019's retail-heavy market structure. This is institutional accumulation disguised as a boring type of crab market through this extended, boring business cycle. And fourth, policy clarity. Like it or not, the Trump administration has been explicitly pro-crypto. So all of that regulatory uncertainty from 2019, 2020, and even onwards, that is largely resolved. So we have a pro-crypto administration in place for the first time ever as we are getting ready once again to go into a short-term and long-term liquidity event. A lot of people like to blame the current administration, saying that it's their fault that crypto is failing in price and falling. It has nothing to do with the current administration. It has everything to do with Fed policy and the fact that we've been in this multi-year quantitative tightening environment. So let's connect all of these dots. QT ends December 1st. The Fed stops draining $95 billion per month from the system. That's over $1 trillion per year that's no longer being extracted from financial markets. Does it mean that markets just go parabolic on December 2nd? No. Liquidity works faster than business cycles, but it's still not instant. But here's what I think the critical insight is. We don't need 90 days this time, like last cycle. The shutdown resolution is a nearer term catalyst that we did not have last cycle when quantitative tightening ended in September in 2019. As the SEC continues to approve altcoin ETFs, ETF inflows can move billions in weeks, not quarters. Institutional buy side has been positioning all year. We've seen it. So the 2019 roadmap suggested 90 days before crypto showed signs of any type of bullishness post-quantitative tightening. But 2019 did not have these accelerants. And here's the thing about these markets. If you wait for confirmation, you're already late. And this is the key to being a value investor. It's anticipating these things when it's not popular to do so, and it's anticipating these things before they happen. Because markets do not wait for economic data to catch up. They front run it. That's why 2019 saw accumulation before the eventual move got cut short by COVID. So here's the bottom line. The end of QT creates a more constructive market environment. It's not bullish overnight. It's not guaranteed parabolic moon overnight, but it's constructive. And this is not something we've seen in years. You're now moving from active headwinds to neutral, potentially tailwinds, from years of drainage to now stabilization, from contraction to potential expansion. And then once you add in the structural shifts, institutional adoption, regulatory clarity, liquidity events, supply redistribution that is happening, and you have a setup that looks very different from the one that we had in 2019 post QT. Now, I know what you might be thinking, because I think it. Could we get another black swan? Of course. I mean, anything can happen. We have to prepare for all scenarios. Could the macro completely deteriorate? It's always possible. But sitting here with the data that we have, trying to time the absolute bottom while the Fed pivots monetary policy, that's how you miss. The first phase of QT ended September 2019. The second phase ends December 2025. I'm not recommending for you to do anything, but ask yourself one question. Are you ready? Appreciate you watching, everybody. If you enjoyed this content, if you got any value from this video, please consider giving it a like. Hit the subscribe if you're not a subscriber. Get into our intelligence system. We've got that free trial going on right now. Hit the link below. I'll see you in the next video. God bless.